Greetings, everyone. I go by the name of PE ratio. PE ratio is price earnings ratio, and all this is pertaining to the stock market. I like the name. That's what I'm called, and everybody that's in the stock market should know what a price earnings ratio is, and you can find this by taking the price of the stock with the Amazon or whatever it is, and dividing it by earnings per share (EPS), and you'll get that number, PE ratio. So we're gonna talk today about trading versus investing, and um, I'm dealing with a wisdom tooth that I need to get pulled out. So just bear with me. I'm in a little pain, waiting on my dentist appointment. But anyway, with the rise of traders today, when I turn on the internet and YouTube, and I'm looking for stocks. Everybody's trading. No, everybody's trading. So nobody's investing anymore. Nobody's long-term investing anymore, like Warren Buffett style. Warren Buffett had a quote saying that the stock market belongs to the patient. Patient, the patient, meaning that if you're going to be invested in the stock market, it requires some patience if you want to be successful. Warren Buffett is known as one of the gurus in the stock market. He is known as the oracle of the stock market. He's done extremely well by by getting small returns. So why wouldn't we follow him? He is what you call the epitome of an investor as pertaining to the stock market. So why wouldn't we listen to him? So this is what I'm going to say. So trading versus investing. Investing is a more long-term approach, like maybe I say years. I'm a long-term Apple holder. I've been holding Apple for over 10 years. So uh, I bought Apple back in 2014, and it was like trading at $120 a share. That was back then. So I've been rewarded by watching the stock go up. It's like up over 400%. But the stock also has stock splits, and sometimes with those you, um, stock splits allow new investors to come in, because when if you know anything about stock splits, they say okay, let's say like okay, we want new investors to come in, so we're going to reduce the price of the stock. So they say in this case, I think Apple reduced by four. I think I got to look back at it. So let's say the stock was trading at, because it was trading like $2,000 a share, something like that, and they divided it. I think it was like $1,000 a share, something like that. And they divided it by four. They divided it by four. So when they divide the stock price by four, it allowed new investors to get in, and but they had the people that was already holding stocks, their shares were multiplied by four, so they could have the same market value of the stock. And we'll talk more about that later. So investing is investing over a long term period, holding your stocks. So there's no, if I was trading Apple, there's no way I would be able to get that 400 and I think when I checked it was like a close to 460% return right now. There's no way I would be able to get that. And what I do is like when I invest, Warren Buffett said this. He said, if I give you $1 million, I want you to invest in three companies, and that's what you have to do. So you have to research those three companies to see if they're making money, and and um and see if they're investable. You can't invest in a company if it's not making money. What sense does that make? There's so many people that I see that recommend me stocks, and I say, okay, why do you like the stock? They say a whole bunch of stuff. I say, well, how much money is the company making? And they don't know. That is that. Listen, that is not that is not it. You don't invest in companies that don't make money. And if anybody know about this Enron stock, I think it was Enron. So Enron was was part of the reason for the 2000 crash, and the 2000 crash, everybody's recommending Enron, and nobody decided to check the financials. Nobody decided to check not a lot of people decided to check the income statement, see if the company was growing its revenue, was making money. Nobody decided to check the balance sheet to see that if the company was handling its debt well. Nobody did this. If they would have done this, then they would have saved themselves for taking a drastic loss, because you don't ever invest in companies that make money when you are an investor long term. Okay, now trading, you may can do this with trading. Now trading is like, okay, it's you can do this with trading because you're just trading the company. And as a trader, you have to really understand the market. You have to really understand how the market is flowing. You have to understand like technical analysis. When I say technical analysis, that's you have to start reading candlesticks and stuff like this. And there's a saying that said that if you don't have 4 hours or more to minimum, 4 hours or more minimum to trade, then you shouldn't be trading. Now, there's a study that says that investors do better than traders over time. Traders only hold their stocks for minutes on at a time. It could actually minutes at a time to maybe a couple of months. They don't hold long term because they're in and out of the market. They're impatient. That's what it is. I recommend that you do not just just focus having your sole income on the stock market. I recommend you do not do that. If you have a job, if you're an entrepreneur, great. Make your money that way and take some of that money and invest in the stock market. But today you have a lot of people that's in the stock market that's trying to use this as income. And what they're not telling you all is a lot of them are taking a lot of big losses. They don't understand it. They don't want to work. See, I don't mind working. I'm an electrician as a trade, but I've been in the stock market for over ten years, and I read a lot of books on it. I just like investing because I am a student of the game. I have a strong foundation while understanding of the stock market, while understanding um, fundamentals like PE ratios, price to earnings ratio, how to read a income statement, how to read a balance sheet, how to read a cash flow statement. So I take a good amount of that money, probably 8 to 10% of it. That's what you want to do, and invest it in the market and let your money make money over time. You know, if the traders want to trade, that's okay, but I'm not. This is not for them. This is not for them. This is for ordinary people that have a job, that have a career, that want to make money in the stock market over time. Okay, so I had some notes here. So it's saying that investing takes a long term approach to the markets and often applies to such purposes as retirement accounts. So you have that. Okay. Um, while trading involves short-term strategies to maximize returns daily, monthly, or quarterly, right? Okay. So what else? Investors seek larger returns over an extended period of time through buying and holding. Traders, by contrast, take advantage of both rising and falling markets to enter and exit positions over a shorter time frame, taking smaller profits more frequently. Okay. What else do I have here? Excuse me. So the goal of investing is to gradually build wealth with investing. With investing, the goal of investing is to gradually build wealth over time. This is done by buying and holding a portfolio of one or more asset classes. This can include stocks, baskets of stocks, mutual funds, bonds, exchange traded funds, which are ETFs for short, and other instruments. This could also include cryptocurrencies. I'm not a big cryptocurrency fan because I don't know what I'm buying into. As opposed to stocks, I know that I'm buying stocks in a company. So when you buy stocks in a company, you you they issue you shares. So the company, Intel, Apple, they go to the investment bank, and the investment bank gives them a certain amount of shares, which are called outstanding shares. They say, here, we give you a certain amount of shares here. It's the only amount of shares you get. So what it does is it the company will say, okay, we will issue you some shares of our company as an investor, and you can profit over time. So that's what this is. That's what this is. You know. So what else? We have here markets inevitably fluctuate. Investors ride out the downtrends, expecting prices to rebound, and can deal with losses and understand that losses will recover over time. So as investing, we don't pay attention to losses. These little losses. You don't lose until you sell. So these are unrealized gains. So let's say you own Apple. You bought Apple for, which I did for $100 a share, for 125 a share. Let's say Apple would go down to $110 a share. I'm not worried about that. Why? Because I know I bought a good company. I check the financials. I check to see if the company making money. I check to see if the market share of the company, how much market share the company has, its competitors. I look to see if it's better than its competitors in that market, and Apple has shown to be that. And then I decide to buy the stock. I also look at the graph and make sure the graph is going at a trajectory slowly up and stuff like that. So that's small technical analysis. I'm not, as an investor, you don't want to be too big on technical analysis, but you do want to understand stuff like the 52-week high, the 52-week low, relative strength index, 50-day moving average, 200-day moving average. These are stuff I do pay attention to, and I can show you those in the long run. But for right now, I'm just giving you this right now. So just telling you the difference between investing and trading. I need you all to understand that there is a difference. Everybody's trading right now. Nobody's telling you to hold a company for 5 years, 10 years or more. That's what you should be doing, because people who have companies, and you have a 401k, you have an annuity, etc. These people that's in the 401k, they're not constantly day trading your stock, your portfolio. They'll probably lose it all. They're not doing that. So if these hedge fund managers and these people that own your 401k, or the people that own your annuities, if they're not day trading your funds, why should you? I understand there's a little bit of money in there, but there's statistics that show that long-term investors do better than traders over time. So I'm talking to the investors right now. And the traders, you can trade all you want, but I'm a long-term Apple holder. When I invest, I go big because I know the company's making money. I did my I did my understanding of it, the financials, check the financials, see the company is making money, and I invested $5,000 in it, and now it's a $35,000 gain, well, market value. So market value 35,000 minus 5,000 I put in, that's 30,000 over time. See, traders can't get this. Traders cannot get this return. And that's why I like the Warren Buffett approach. He says the stock market belongs to the patient. Patient is people that's willing to just stay long term in the company and reap the rewards over time. I think Warren Buffett himself is making like $400 million a year in Coca-Cola from dividend stocks. That's because he got into dividends in like in 1992, 1991, right? So he's getting rewarded by holding those over time. You know what I mean? So this is what I want to say. And let's go here. I went to Investopedia. Let me share my screen real quick. 1 second here. You see here investing. The goal of investing is to gradually build wealth over time. So I'll come in Investopedia and just see this type of stuff. I'm not going to bore you all with this stuff, but just take a good look at it. Come to Investopedia and just take a good look at it. Type in investing versus trading, and you'll see what the difference is. You have to know the difference if you're going to be in the stock market. You understand what I'm saying? Um, what else? Let's see here. Um, the goal is the goal of investing is to gradually build wealth over an extended period of time. This is done by buying and holding a portfolio of one or more asset classes. This includes stocks, baskets of stocks, future mutual funds, bonds, exchange traded funds, etc. Investments are often held for a period of years or even decades, taking advantage of perks like interest, dividends, and stock splits, which I mentioned earlier. So that's all I have for this. If you all have any questions, feel free to leave it in the chat. And I know a lot about the stock market. I invested in companies like Apple. I invested in Nvidia in about 2015. I thought it was I thought it was high. It was like $125 a share. That company went on to be a $2,000 stock, and then it split. If it didn't split, it'd be close to a maybe close to a $2,500 or $3,000 stock right now. But you know, nobody's a lot of people not rolling like that where they could spend money on a $2,500 stock. Now they do have something where you can buy when you can buy part like you don't have to spend $2,500 on the stock. They have it to where you can buy the stock partial. I forgot what the terminology is, but you can buy part of the stock. So you can spend about $50 and get part of the stock. You couldn't do that when I was investing many years ago. You couldn't do that. No, you had to buy whatever the stock was worth. That's what you had to pay. So that's something new today. And truthfully, you don't need stock splits when you can do something like that. When you can buy into the stock for $50 or $100. I forgot what they call it. I think it's like partial stock. But the psychology behind this is that when investors see a $2,500 stock, they were like, "Well, that's I'm not." They thinking the newbies and the immature investors thinking that, well, how much more can that go up? I'm not gonna mess with that. But when you have the stock split and let's say you brought it from $2,500, let's say you had a maybe a 10 for one stock split or 10 for one stock split, then That means that you divide the um you divide the company by 10. So the stock price would be $25 a share instead of 2,500 dollars a share. And the people that had one stock, let's just say they own one share in the company, then you will multiply that one by 10, which would be 10 shares. Now you have 10 shares. If you had um 10 shares in the company, then you multiply those 10 shares by 10, now you have 100 shares. This is just to give you the market value, because whatever you do to one side, um, I ain't gonna get algebra. Algebra. I remember algebra. They were saying once you do whatever you do on one side of the equation, you got to do to the other side. So if you got 100 shares, if you have 100 shares of this 10 shares of this company, and, and you says equals um, whatever the company, whatever on the other side of that, it has an equal that market value. So let's say you have 10 shares at $2,500. You know, 10x has to equal 2,500. I don't want to get too caught up in that, but I have to write that down on the board for you all. But I don't want to get too mathematically stuff with this. But if you have a stock that's worth $2,500 and they say, okay, we're going to do a 10 for one stock split, then you have to divide that company by 10. So 2,500 divided by 10 will give you $25 a share. So the investor that already has 10 shares, like, hold up, how you going to just decrease the stock like that? Well, I paid X amount of dollars for it. So how you gonna do that for these new investors? And the company will say, don't worry, we're gonna give you more shares, and it's gonna equal the same amount you already had in the account. And the investor was like, okay, okay, that makes sense. I have no problem with that. That's it. That's the way it is. So here we go. If you have any questions, feel free. I'm trying to do some better understanding and stuff like that. Maybe whatever I could do. Maybe I got to write stuff on the board just so y'all can understand it. Because I understand this. I research it all the time. Y'all, I got some papers and I'm options. you know, I love just study the stuff. I just keep on studying, and that's how it goes. So peace.